All right, so today I wanted to talk a little bit more about dividend growth stocks. I'm going to make a video on, I'm talk about 5 stocks. These are the stocks that I've came across that are growing their dividends the fastest, that I'm comfortable investing in, although some of them are a little bit expensive, and I will get into that as well. The first one, Old Dominion Freight Line. This is a company that I've talked about before. They are kind of like an integrated transportation company. Again, I think I mean, it clearly is a growing industry, and I think it's an industry that's going to keep growing. Again, they've absolutely destroyed the S&P consistently over time. I mean, if you look, I mean, if you go like the S&P doesn't even show up here. Again, 31,000% it's up over the last 23 years. Even if we go back 10 years just to make a better comparison, it's up 1,300%. If we go back 5 years, it's up 270%. So again, this is a company that's consistently just destroyed the S&P. It does have an earnings yield of just 3.7%, so it's not that high there. But again, it's growing that dividend very nice. Again, it has a very low dividend right now, only 0.47%. But again, it's growing at 35% a year, meaning they're literally doubling their dividend every 2 years, roughly, right? So that's what you need to know, right? If you have a company that's doubling their dividend every 2 years, well, it doesn't matter how high that dividend is, right? Because again, my philosophy is I want companies that are going to have very high dividends down the road, not companies that have a high dividend right now. I do like some of those companies, right? I have a position in some oil companies. I have a position in JEPI, Ares Capital. I do like those companies, but I have a bigger position in these companies because they're going to have a dividend yield that is going to be 20, 30, 40, 50% when you go out 20, 30 years down the road. Now, I would also stress that you definitely want to diversify, right? You don't want to put all your eggs in one basket or two baskets because there's nothing forcing companies to pay dividends, right? They're not REITs, right? REITs have to pay a dividend, but a random company, they don't have to pay their dividend, right? Now, when they have a track record of doing it, very, very likely they're going to keep doing it because it would look very, very bad to not do it, right? So they're going most likely, 95% chance they're going to keep paying that dividend. They're going to keep increasing it, right? So again, this is a company that I very like. Although, got to keep in mind it is expensive, right? It is a 40 price to free cash flow right now, so it is expensive. But if your goal is to dollar cost average and wait 20, 30 years, you probably don't care, right? I don't personally care. I'm not getting in a massive position right now because I do want to get it cheaper. If this company did get cheaper, like if the price of free cash flow went below 30, that's when I would really want to get in here. Uh, so again, very, very much like this company. Again, just growing very, very nicely. Um, Again, like look at the insights on this company, right? Very profitable. It's growing very good. Very good financial health. It's buying back shares. It's very profitable. It has very good returns. I mean, 37% return on equity, like just amazing, right? So again, this is honestly, in my opinion, it's everything you're looking for in a company. Like I said, my opinion, do your own due diligence. The next one, company I've talked about before, EQB. This is a Canadian bank, online bank. Uh, Again, not growing quite as fast, but again, this does have a little bit higher dividend right now, right? I mean, for a bank, it's not a high dividend by any means, but 2.36%. It's growing at about 23% a year. Very nice, right? But they've been growing their dividend. I mean, it looks like they stopped doing it in late 2019. I think we know why that was, and again, that they started increasing it again starting in the end of 2021. So again, that does make sense. Again, very nice dividend growth, right? Very nice dividend growth. Again, this is a company that is very profitable. I mean, it's not even expensive, right? I mean, you have an 8 PE, right? 0.8 price to sales. So it's not expensive by any means. And again, another company that's consistently outperforming the market, right? That's exactly what you want to look for, right? Very profitable, very good growth, very good financial, not very good, but pretty good financial health. Again, honestly, in my opinion, as far as a bank goes, this is exactly what you want, right? This is exactly what you want from a bank. Um, the next one is another company I've talked about before. This is ATD. This is a company that just trades on the TSX, like EQB, another company that just trades on the TSX. I have a lot of Canadian companies in here, not by intention. They're the best ones that I've came across. ATD.to. This is a company that owns like convenience stores and whatnot. I believe they're basically worldwide. They're in Canada, the States. I believe they're in Europe and Asia as well. They don't actually, yes, they do have a description here. So again, Scandinavian countries, Baltic countries. So again, 24 different countries, right? So they are worldwide. 122,000 people, 14,300 stores, right? So again, um, if you look at the free cash flow yield, earnings yield, 5.5%. So it's pretty good there. Again, another company that's absolutely destroyed the S&P. Again, it's been around since 2000. So again, it's been around the tech bubble, the '08 crash. Again, EQB was around during the '08 crash. It was fine. So again, people that are worried about the banking crisis or potential banking crisis right now, EQB's been around for it. It was fine. Old Dominion, again, also has been around. It was fine in the long run. Another company that, again, been around since 2000. Again, it's made it through every single time, right? Although it looks like it did take a long, like it was $2.50 there. It went down roughly to that in 2009. So, I mean, it looks like it had about a 7-year period where it was basically flat, which again, it very well could happen again. But again, if it's growing that dividend, then who cares, right? I mean, honestly, like a lot of these companies, if they return, like the share price returns like 5% a year, honestly, it wouldn't even bother me all that much, because when you're getting 20, 30, 40% dividend growth per year, who cares, right? You're going to have a dividend that's going to be in the double digits 10 years from now, and it's going to be 20, 30, 40, 50% 20 or 30 years from now, right? So again, as someone who's very young, to reiterate, these are companies that I like, because you're not going to care about the stock market going down 20 or 30% when you have a 30% yield on cost. I mean, you will care, obviously, but you're not going to care that much, because you're going to have a 30% yield on cost. You're still breaking even, right? Again, these are the companies that I really like. Like I just love these kind of companies, because this is how you build wealth, right? You build wealth by buying good companies, but these are companies that are very easy to figure out that you're going to make a lot of money on, right? It's very easy, because you just have to notice a trend and follow the trend, right? Again, consistently outperforming the S&P, consistently growing that dividend very, very well, right? It's such an easy trend to follow, right? Again, this is another company I like. It is priced actually, even though it's basically at an all-time high, it is priced still fairly well. It is a little bit above its 5-year average, but again, price to free cash flow of 20 for a company that's just destroying the S&P. In my mind, that's still not even expensive, right? So, in my opinion, I guess. So again, another good company. The next one I wanted to talk about, again, I've talked about all of these companies before, but I wanted to make a video on them specifically. Universal Display. This is actually a technology company. Again, they make a lot of the components that go into like screens nowadays. I'm sure people have heard of OLED TVs or QLED TVs, right? But again, it also goes into computers, phones, like you name it, right? Does anyone really think we're going to have less screens 10 years from now than we do now, or 20 years from now than we do 10 years from now? Like, this is another area that I think is very good, right? It's very good. Um, doesn't have a high dividend right now, but again, it's growing 42% a year. Like, that is just utterly crazy. Again, it's not going to happen. I don't think they're going to be able to. I don't think any of these companies are going to be able to grow at the rate they're growing over the next 10 or 20 years. Don't get me wrong. But even if the dividend goes down a little bit, like, it's going to have to go down very significantly to make me actually worried, which I don't think is going to happen. I mean, it may happen for one or two of these, but at the end of the day, even if you hit a home run on one or two of these or three of these, two or three, let's set the over under, right? If you hit a home run on two or three of these, which I think almost certainly will happen, honestly, you won't care if one of them stops growing their dividend, right? I mean, you won't care because if you can hit on two or three of these, those are just home runs that you're gonna make a lot of money off, right? So that's another point that I think is very important. The last one I wanted to bring up, another company that I've talked about before, Go Easy, again, another Canadian company. Um, Again, they are in the financials industry, but you also need to keep in mind that, again, they made it through the 2000 crash, they made it through the '08 crash, just fine, right? Just fine. This is a company, of all the companies on here, this is the one that's probably the best buy right now. If you were to buy just one of these right now, it probably would be Go Easy because they're literally down like more than 50% from their all-time high. They have an 11 PE, again, not crazy by any means. Um, they might have the toughest time growing, at least compared to something like ATD, right? Or even Old Dominion. But again, they're growing that dividend 38% a year, and it's currently at 4%. And look at the payout ratio, 45%. So they still have a lot of room to grow, right? They still have a lot of room to grow, and they're going to keep growing, right? So again, uh, if I were to buy one right now, it would be Go Easy, simply because I think their price valuation is the best. But honestly, I would probably separate things rather evenly amongst these. I think OLED, I also forgot to mention, they are very expensive right now. They have a very high price to free cash flow. So I would be a little bit, I'd be dipping my toes in very, very skeptically with them. I would prefer to get them cheaper. I think they dipped below $100 briefly, not that long ago. Although I don't think that's very unlikely that'll happen again, at least in my opinion. If you could get them like 110, 120, I think that'd be a better number. But again, you got to keep an eye on these valuations, right? Again, that's another very important thing when it comes to every company. You got to keep an eye on the valuations because, again, you can have the greatest company on earth, but if you're paying a massive premium for them, is it a good idea? Most of the time, it's not a good idea. So again, that's another thing you got to keep an eye on, right? You got to be very, very careful with that. And that's why, that's another reason why dollar cost averaging is a good strategy because, okay, you might give up a little bit of upside, but you also take away some downside. And if your goal is to hold the company for 20 or 30 years, honestly, you don't really care if you get in at $100 or $80, right? You probably don't care. It's the difference between returning. I mean, if it's a difference between returning 1,000% and 950%, like who's going to care about that? Like no one's going to care. So that's just my philosophy, right? That's my philosophy. These aren't necessarily my top 5 companies to buy or to own, but they would all definitely be in my top 20, possibly even top 10, right? I do like every one of these companies a lot. And again, the reason is not, it might not be that they're the greatest businesses in the world. I think some of these are very good businesses, but actually they're all pretty good businesses, some of them very good. But again, if they can grow their dividends even close to where they're currently growing them, these are all going to be complete home runs, like absolute home runs. Like you are going to just, like, my God, am I happy that I'm returning 30% every year just owning this company, just holding it, right? So anyway, that's what I wanted to bring up today. If you liked the video, hit that like and subscribe if you haven't already, and stay tuned for more.